July 1, 1990 Real Estate Capital Basics, Standby Commitments. Standby commitments are temporary financing tools required for obtaining construction loans on speculative, to-be-built, or major renovation projects. Based on a predefined set of terms and conditions, the standby issuer, lender, provides a commitment to finance a to-be-built project at a future date. Relying on this commitment as a takeout funding, a construction lender provides the necessary funds to complete the project. Simultaneously, the borrower is certain that financing is available when the project is completed. Regular, presale and suicide are three forms of standby commitments found in the marketplace today. Regular standby. With a regular standby, the issuer is prepared to take out the construction loan upon project completion, providing the borrower with a mini-perm, short-term, first mortgage. The mini-perm debt is usually underwritten as a fixed or floating rate, accrual loan. Real estate investment banks, credit companies and other entrepreneurial financial institutions are popular sources for this rare type of financing. Regular standbys are highly suitable for financing extremely challenging properties including lodging, healthcare and highly speculative developments. Presale standby. A presale standby is essentially a pre-purchase agreement, allowing the issuer to purchase the property upon completion at a predetermined price. The purchase price is discounted to allow for the time value of risk, and at a minimum, cover the construction costs. Life insurance companies, pension funds and other institutional equity investors provide this type of funding mechanism in an effort to acquire difficult-to-purchase properties. Borrowers are actually merchant builders in these situations, resorting to presale standbys as alternatives to other maximum leverage funding vehicles, for example joint ventures. Suicide standby. As the name implies, a suicide standby is a funding structure of last resort. The standby issuer offers a commitment with extremely arduous terms and conditions, effectively discouraging the borrower from funding the loan. For instance, a loan term of 400 basis points over bank prime plus a 5% fee reflects very unfavorable takeout funding terms. The issuer earns hefty upfront fees as well as highly punitive profits upon construction completion. The borrower uses the suicide standby to develop or renovate extremely challenging properties, hoping that more favorable permanent financing or market sale conditions will be available upon project completion, eliminating the necessity of funding the suicide standby. Funding requirements for suicide standbys are similar to other standby vehicles.